Good afternoon. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll also take a quick look at the U.S. dollar. We'll see how oil, gold, silver are reacting to whatever fluctuation the U.S. dollar has, as well as taking a look at Bitcoin and Ethereum. If anyone in here has a chart request, feel free to type it into the chat, and I'll be more than happy to go ahead and take a look at it once we kind of go through all the markets and commodities. If you like what you see here, you can always follow me on Twitter at StockDarts, or visit me at YouTube under the same name. Or probably the best scenario would be to just go to patreon.com/StockDarts, where you can find weekly blog content, including trade ideas, watch list ideas, as well as the reposts of these Wednesday market reviews. And like I said, that's typically, if you're looking for more content from me, that's the best place to look. Let's go ahead and get started. The first thing we're going to do is look at the S&P 500. We're going to do it through the ETF SPY. This has been an interesting week. It's not really a good time to trade right now because of earnings season, and that was kind of the focus of my post on my Patreon blog this week. Monday was, the market was due for a bit of a pullback, and you could see we had a little bit of that on Monday and Tuesday, although the buyers have kind of returned today. You can see we're green across the board, particularly with the small caps, although that was the index that kind of took the most damage on Monday and Tuesday. I think there might be room for a little bit more of a pullback, but what makes it a tough trading environment right now is the fact that we have the vast majority of stocks that are nice volume are going to report in the next couple of weeks. And so as far as swing trading is concerned, it becomes a very difficult time to trade because the stocks that you are looking to buy often have a very small window of opportunity as far as being able to trade them unless you're willing to hold through earnings. And as we'll get to in a minute with Netflix, you'll see that it's often not a good idea to try to swing trade through earnings. There's of course several types of trades that you have to hold through earnings. If you have a long-term hold, if you have a position trade that you're holding through several quarters, well, you're going to have to go through earnings reports. Or if you're like me and you like to trade earnings reports specifically, then there are several styles of trades that you take in which you are going to trade overnight looking for a big earnings move or a lack of an earnings move in one direction or the other using options. However, if you're just someone that's directionally swing trading, trying to, buying a stock, hoping it goes up or down depending on whether you're shorting, within the course of maybe a week or two, you tend to not want to go ahead and hold through earnings because it introduces a lot of not only volatility but sort of an unknown factor because you don't know how the market is going to react to an earnings report. I've been trading earnings reports for more than a decade now, and it seems like there's often not really any rhyme or reason to why they go up or down. I've seen plenty of really good reports where the stock ends up selling off because the market was anticipating that and it was kind of already baked in, and vice versa, where there's reports that look like they're pretty bad and the market eats it up and the stock rallies. And so, generally speaking, I found that trying to trade a direction during an earnings report is usually not really conducive to very steady trading profits. What I found is that volatility is a little bit more predictable. And it's easier to kind of gauge because in that case you're not really married to one direction or the other. You're just worried about the volatility and the type of move that happens. But that's a discussion for another day. The big key here is that you never really know what's going to happen with an earnings report, and so your number one goal as a trader is to manage risk. And if you are sitting there holding through earnings, you're basically kind of doing yourself a disservice because that's the one thing you're not able to do at that point is manage your risk because there's potential for overnight gaps in either direction, oftentimes well past what you considered your stop out point. And so it makes it difficult in the first week or two of an earnings season to really recommend a lot of swing trades because, like I said, many of them report earnings in about 6 or 7 days, which gives us a very, very small window in order to trade them before we have to exit the trade prior to the earnings report. When you couple that with the fact that we have a market that's overbought, has been stretched out for a couple weeks now, as you can see, if you take a look at the S&P 500, once we broke out here on April 1st, we've rallied pretty significantly, and now as we hit the middle of the month, you can see we finally had a couple of red candles, and we're finally, starting to see a little bit of selling pressure. And I expect this to probably come down and test the 20-day moving average. But what ends up happening here is you have a market that's overbought, probably due for a pullback, but it's a very strong bull market, which means you don't really want to short it either. And then when you combine that with the fact that we have many names reporting earnings, which could introduce not only volatility in the actual stock you're trading, but considering most of the FANG stocks report in the next couple of weeks, that could also introduce volatility into the overall indices. And so this is a week where I decided to take it pretty lightly and not really look for too many trades to take, and more than anything maybe focus on a few cryptocurrencies which were undergoing their own correction recently as well. And start to look at earnings trades and start scanning for possible earnings trades that I want to take. And so, this might be a good idea for you guys as well, is to just make sure you're careful and make sure that you don't get too aggressive trading right now until we see more earnings reports start to filter through. Now, the flip side of that, of course, is once you see earnings reports come through, well, that's a good time to go ahead and start looking at those names. If you're trying to avoid the uncertainty that comes with earnings, well, the best way to do that is to wait for the earnings report and then trade the next day or the next week once it kind of has that, and then you can just kind of gauge a better reaction based off of what the report was and just trade the regular price action. And so that's something I often recommend to traders that are not comfortable following my options trades or are not comfortable with options, period, is you don't necessarily have to try to trade in earnings by holding overnight. What you could do is wait for the report and then just play the reaction off of that. And I've often found that that's one of the higher percentage styles of trade that I could take, is look for an earnings report where a stock maybe overshoots what the expected move was, and then go ahead and try to play a mean reversion trade based off of that. And so, long story short, as we have already kind of gone almost 10 minutes and I haven't really gone over any index yet, is, make sure that you are careful this next week or two as we go through earnings season. Now, as far as the S&P 500 is concerned, like I said, we had a couple of selling days on Monday and Tuesday, and you can see we've gotten a reaction today, a nice green candle, as we find buyers starting to step in at a pretty decent level to expect support to come in. We're going to zoom in a little bit, and we'll put a little trend line, and you'll see that this is kind of the level where we first started to hit the top of our channel, right? And we had a little bull flag, and then we kind of accelerated past the channel, and then we've come back and retested it. This is pretty short term. This is not a significant level that I would expect a lot of support to kind of come in, but it is typically the first line of defense where the bulls will start to step in and see if they could get some action. Now, like I said, I suspect that with the action that we're seeing here, that we're probably going to have to come back and test the moving average. What often happens during a strong trend is the 20-day moving average becomes kind of a bellwether for the strength of that rally. And I think it's probably where we're going to come back and test. As you can see at the moment, if it actually came back and tested the 20, it would kind of coincide pretty closely with the previous impulse upwards, where we also had a 2 or 3 day move and then a little 2 or 3 day bull flag before we did the same thing again. And so there's a pretty good chance that we come down and test there. However, considering the strength of the bull market that we are in, and even the rally in the short term that we're in, there's always the possibility that we have already seen the correction we needed to see, and that we continue to kind of make our way upwards. And so that's why, even though I'm trading pretty lightly this week and wasn't that excited about looking for too many trades, I still have a few in there in my pocket just in case, because as long as this market is this strong, you want to have a stock ready to open or ready to buy if the market decides to rally. And so I don't want, you don't necessarily want to ignore the markets and just take the next 2 weeks off. You still want to have trades available just in case the market does rally. Although, like I said, today's candle's nice and there is the possibility we do rally. But my expectation is we probably need a little bit more correction and a little bit more time to take a breather, which means we'd probably come down and test the 20-day moving average. While the market itself looks okay, my watch list shows a lot more names that have maybe started to endure a little bit more technical damage, and I've seen a little bit more erosion in the price action than what you are seeing on the indexes or on the indices. And so, keep that in mind as we go ahead and move forward. Like I've said before in the last, the last several years, Even if you are trying to trade a bull market like this, you don't want to chase the price action. You don't want to at this point you don't really want to mimic stocks that are doing necessarily what the S&P 500 is doing. What you want to do is look for stocks that maybe have longer consolidation patterns already in place, or are giving you potential entries at better support areas. Now, that being said, for momentum traders, this is actually not that bad of a place to go ahead and look for a momentum trade. So there is, like I said, the chance that we do kind of rally from here. And the key is, of course, are we going to build on today's candle tomorrow and push past it and push past these two candles that we just saw the last couple of days that turned red. Now, what are the key levels on the S&P 500 if we do rally, or more importantly, if we do pull back, right? And so like I said already, the 20-day moving average, which is going to coincide with another short-term level around 406, is pretty important. But the real key area here, if we do see selling accelerate, and we see more red like we did on Monday and Tuesday, and we lose the 20-day, well, the really strong area of support here is right around 400, just below it at about 397, 398. As you can see, that will be right around where the 50-day moving average is. That will also be the ceiling of this temporary consolidation range that we spent most of February and March in. And that will likely be a very good buy the dip opportunity, and probably a stronger point for the bulls to defend than what we're seeing right now, right around 411, and what we might see around the 20-day moving average. The key support area for me right now is going to be this 397 to 400. I don't anticipate us losing this level unless the earnings reports over the next couple of weeks are really, really bad. If you start to see Apple, Amazon, Google have very poor reports, then there's a chance that that's going to impact the overall markets. Or if whenever we have our next FOMC meeting, if their language is a little bit more negative, then maybe that will push us down. But just trading off of the price action we're seeing right now, I don't expect us to lose this level on whatever pullback we get, if we do get past the 20-day moving average. I would expect support to really stabilize here around 397, and like I said, would be a good spot to go ahead and start looking for reversal patterns. Now, as always, just because it hits the level that you're looking for doesn't mean you buy immediately. You still want to see support confirmed, and you want to see a reversal pattern, kind of like what we're seeing today, back in those levels. Now again, today's reversal pattern might hold or might not, but you always want to buy on the green candle. You don't necessarily want to buy on the red candle, because there's always a chance that you see a big string of red candles, and momentum typically takes a little bit of time to go and reverse. As you can see, the last couple of times that we tested the bottom of this channel, that we tested the 50-day moving average, we had big red candles, and if someone would have bought this red candle, say on March 3rd, they might have been shaken out on the next day. And really, it was much better if you waited for these two long wicks in the hammer candle before trying to buy on the bottom of this channel. And same thing over here. There's a nice string of selling candles, and we came down, and really the best time to buy was when you start to see green and you start to see a reversal. And so it's going to be the same case if we do have a couple of big red candles. If we see volatility increase and we move past the 20, look for a green candle, some reversal patterns around the 50. I think that's really probably the safer spot for those of you that are a little bit more cautious or still worried about this market. That being said, there's a pretty good chance we don't get there. Like I said, we could bounce off of just today's candle, or maybe we come and test the 20 and then bounce off of that. The moving averages are still intact and are still indicating a pretty strong trend. And my fears of a market that was going to transition sideways, while they're still in place, the longer the market does this, the more chances that they end up not really materializing, and we just continue to rally. Now, sooner or later, the market will taper off and start trading sideways. But as we can see, I thought that there was a good chance it was going to happen here in March, and that has not been the case so far, and we still have a pretty strong trend intact. And because of that, we should continue to look trading to the long side, and we should continue to avoid trying to get cute and trying to call a top and trying to short this market. It's not a good time for that. Even though I suspect that we're going to pull back here, it's not a good idea to try to short this or to buy puts or anything along that nature, because you're just probably throwing away your money. Because like I said, there's a lot of bulls that feel like they've missed on a lot of this move, and that's why you get candles like you do today. As soon as you see one or two selling candles, you're going to get green. And that happened even over here when the market was correcting. There was a lot of big swings up in the face of selling, because there was a lot of bulls that were trying to get in early because they felt like they missed the rally up into that area. All right, so that's the S&P 500. Like I said, to the upside, by the way, clearly there's not a lot of not a lot of points that we could use here for reference. Really, these two candles from Friday and Monday are the only highs that we have. Anything beyond that has never been traded, so resistance above that is basically theoretical. But clearly, we need to see us break past this level. You can see we kind of had some trouble breaking past the 416 to 417 range. So that's going to be the area that we likely probably come up and stall out again until we see a little bit more broader consolidation and see new buyers step in and see more profit taking from this last run up. Now, if we look at the Nasdaq, we see sort of a similar picture, but slightly different. As you can see with the S&P 500, the rally is still very much intact, and we're really rallying to new highs for a while. With the Nasdaq, it was a pretty quick impulse. The Nasdaq was actually lagging quite a bit. As you can see, they had their nice channel as well, and they lost that a while ago. And they actually transitioned towards more of a sideways ranging market. However, money rotated in the beginning of April, particularly as the last couple of weeks, money rotated back into a lot of tech names, and as you can see, the Nasdaq kind of exploded back upwards and printed new all-time highs. Now, just like the S&P 500, it's pulled back this week. You can see with Monday and Tuesday we sold quite a bit, and today's candle not quite as strong and still kind of dealing with yesterday's price action. And just like the S&P 500, I think there's a pretty good chance we come back and test the 20. And also, just like the S&P, that 20 coincides with a pretty decent level of horizontal support / resistance. Now, just below that is an even more important level, which is right around 324. And I think, again, that area between about 328 and maybe about 325, 324 is going to be the zone where we can be a little bit more confident about support stepping in. That's a pretty critical area here on the Qs. When you consider how volatile things got and how it looked like they were maybe going to roll over, coming back into that level, that should act as good support now, what was the ceiling of that range. And so I would expect if we do get a further pullback, for support to either materialize at 329 or a little bit below that at 324. And that's going to be the key areas to watch as far as the Qs are concerned. Now, we had Netflix report earnings last night, and as you can see, it was negative. This is, again, to reiterate what I said at the beginning at the open, why I think it's not a good idea to try to swing trade too much over the next couple of weeks is because, or why it's important to not hold your swing trades through earnings is because you never know when you're going to have a move down. Now, 7% for Netflix is not really that big of a move. That's still kind of muted. In the past, Netflix has been known to move 10 or 20% up or down. But even then, if you take a look at it, that's still a loss of about $40 per share for anyone that was maybe thinking they could trade with a stop somewhere in the 541 to 530 area. And they would have been down quite a bit more if they tried to hold through this, just hoping that they'd get a pop on Netflix. And so, like I said, the key here is that there's always uncertainty during earnings season. Now, what can we gain out of the Netflix earnings report? I don't think a lot at the moment. It did come down to some decent support areas here, and we'll see whether it's going to bounce or whether it's going to kind of bleed down towards its longer-term support. And I think that this might be a tell as far as how the stay-at-home stocks are going to behave as we move through the rest of earnings season. Again, Netflix, kind of a pretty good example of the type of stock that did well in 2020 and has maybe struggled a bit in 2021. As you can see, just take a look at the overall picture here. And towards the end of last year, as we started to get hopes of a vaccine being implemented, and then when we do have the vaccine becoming implemented, you can see Netflix is stalled out, and it's been trading sideways. And there's a big group of stocks like Netflix that have been trading sideways for a while now. And these are what I like to call the stay-at-home stocks that benefit from us staying at home and basically doing our consumption at home as opposed to traveling and going out in the real world. And so this is probably going to be a good barometer depending on what happens here. Now, just a down report by itself is just one day. I don't think is enough to really gauge as to what's going to happen with Amazon or Peloton or any of the variety of stocks that we've been following that are in the same space. But if Netflix can't hold here around the 200, if it bleeds down and starts coming back down into the bottom of this range around the 470 area, then I think that's more indicative of momentum really starting to erode on these names, and the fact that it has to come down and test all the way at the floor of what it's been its price level for almost half a year now, I think will be more indicative of what we can expect out of more stay-at-home stocks. And so today's report by itself doesn't really concern me too much, even if it's down. What I'm looking for is how we react to this around the 200-day moving average and the support that started to materialize in the early to middle part of March. And so that's going to be kind of the area that I want to see if it holds or not. And if it drops, see what happens as we come down to 470. So that's kind of the key here. And like I said, if we take a look, Facebook reports earnings in a week. Amazon reports earnings in about a week. Apple reports earnings again in about a week. Google also reports in about a week. So the rest of the FANG stocks all report next week, and they may have an impact on the market. A lot of these again benefit from stay-at-home style economy, and so we'll see how they behave and whether it's going to affect the overall market. Back to the Nasdaq and to the Qs, we'll see. You'll notice again today's Netflix report really hasn't dinged it too bad. And the key again is, just like Netflix, is what's going to happen as we pull back. Are we going to kind of stabilize at what should be support, or are we going to kind of bleed further down? And if we do, I think that's going to affect the overall markets. And so the Nasdaq is going to be an important index to watch next week as the rest of those FANG stocks report. And in my mind, the important factor here, the important point is that we stay above this little rectangle that I have drawn. If we fall back below that, then I think that's a very good tell that we are likely transitioning towards a sideways market and are kind of done rallying. That's not the case at the moment, obviously, but if we do fall back into that area, I think that that would be pretty indicative of that, unless there's a concurrent move on the small caps in the opposite direction that maybe tells us it's more rotation. But for now, that's the key area. I think in the short term, probably this week we don't lose 330, but the real key is if we lose 324, 323, that 50-day moving average and into this area, that's the spot we want to stay above. And so that's, in my mind, the critical line in the sand with the Nasdaq. And what we're going to do here is we're going to turn this, we're going to borrow this trend line, we're going to turn it red, and we're going to use that as kind of our barometer. Let me use a darker red. All right, so that's kind of the key that we want to watch on the Nasdaq. I think it's an important area to pay attention to. Like I said, with the S&P 500, that area is right around here, around 397. Just for fun, we'll draw a red line there as well. That should coincide with the 50-day and with the bottom of this channel. And just like S&P 500, to the upside, the only resistance we really have is recent highs around 342. Beyond that, it's all clear sailing. Not going to be much going on beyond that. All right, let's take a look at the Dow. As you can see with the Dow Jones, again, pretty strong. This is, like I've said before, indicative of money rotating into, instead of stay-at-home stocks, what I like to call recovery stocks, right? And so in this case, we've got stocks that are, mostly benefiting from the implementation of the vaccine. Travel stocks, airlines, stuff like that. And you can see that we are starting to recover again. Just like the other three indices, we had the sell-off to start the week, and today we're seeing a nice green candle. And again, this one actually kind of pushing its way through yesterday's price action, showing again that the Dow is kind of leading the way upwards and showing a little bit of relative strength versus the Nasdaq in particular. The 20-day moving average has not been challenged. The 50-day is way down here. This is all indicative of a very strong trend, and everything is still kind of going pretty smooth as far as this is concerned. So, as opposed to the picture we saw in the Nasdaq, where we have a market that is maybe in the process of transitioning towards sideways price action, with the Dow we're still very strong and still climbing upwards pretty steadily. As far as what we can expect here, I think that this is going to be very similar to the S&P 500. We should expect support at the 20, and then more likely support to kind of maybe materialize around 331. As you can see, there's a gap here. This is also the area that's kind of the same here. As you can see in March, how we kind of stalled out. With the Dow Jones, it's not quite as dangerous, but you can see that this is the area where we kind of stalled out a bit. And the top of that range is right around 331. So that's going to probably be a good support area. There's a decent chance the 50-day comes up to meet price around there. And then that's going to be right around where support really materializes if we do pull back. As you can see, like I said, the Dow Jones is still showing strength. If we see the Dow Jones lose strength and the Nasdaq holds up, then we could consider that as just rotation. However, if the Nasdaq kind of rotates down and the Dow Jones pulls back with it and loses this level, then I think that's more indicative of a broader pullback in the market. And like I said before, if the Nasdaq kind of stalls out, but we see the Dow rally and we see IWM rally, then I think that that kind of bodes well for the recovery names and tells us that, again, there's a major rotation going on away from stay-at-home stocks and into the recovery names like oil names, travel names, all the kind of industrial stuff that is benefiting from us finally kind of coming back out and being a little bit more safe in being able to kind of rejoin the outdoor society. All right, now the last index we want to look at is IWM, and you can see there's a little bit of a different picture here. Just like the Nasdaq, we've lost our upwards channel. And again, just like the Nasdaq, the channel was pretty tight and really didn't have a lot of room for the price action to kind of stall out. Not the end of the world that we've gone sideways. As you can see, we've got a nice little broad consolidation range here. We have the shadows of a possible head and shoulders here. If you take a look at it from right around here, from 214, we kind of went up to about 230, came back down, found support again right around 210, 214. Came up, made a new high, came down, tested that again, and now we're kind of in the process of stalling out here as we try to make our way back above the previous level. If we head back down and test the 210 area and then break down, I think it's a pretty negative pattern. Now again, this is not an exact head and shoulders. As you can see, the right side is kind of a double attempt here. But the psychology behind it is still the same, which is you make a move up to a certain level, print new highs, come down, make new highs, and then on the next attempt you can't get past the recent highs and you stall out right around the previous highs. And if you come down and fail that, that's usually a pretty negative pattern and could lead to a further pullback. Now, that being said, we're getting ahead of ourselves and assuming that's going to happen. There's a very good chance it doesn't happen. These types of patterns develop all the time because in reality all it is a sideways channel with just an attempt that tried to break out above it. But the key is, with IWM, we don't want to lose this 210, 209 area. That's going to be the critical area to watch. Now, like I said, very different price action compared to the other three indices. You can see the moving averages are going sideways, the 20 cross below the 50, and price action is actually below the two moving averages, the 20 and the 50. We have a return of momentum today, right? We're up 1.5% as opposed to the other indices that are basically around 0.5% or less. If this rotation is going to continue back into the recovery names, then IWM is probably going to need to make a bounce and make its way back above 225 and beyond. If IWM continues to stall out and the other indices pull back, then that's probably indicating that the markets are getting tired and are ready to either trade sideways or even correct a little bit further back down to the downside. So keep an eye on IWM as well. And like I said, I think the key area we want to watch is right around here. And we'll put a red line on this one because I think it's going to be an important price point as well. And we'll put it right at the lows to give ourselves a little bit more wiggle room. But that's kind of the area that I would pay attention to if I'm worried about the market with IWM, is what happens as we pull back down to 208. Now, like I said, the markets in general have actually been behaving pretty well. And there's a pretty decent chance we do try to rally here. And if that's the case, we won't have to worry about some of these red lines I'm putting on our charts. However, the markets do continue to kind of stall out, and we see more of the behavior that we saw Monday and Tuesday as opposed to what we're seeing today. Then we're going to come down and challenge those levels, and probably we hold at those levels, but we'll have to watch them and see how that occurs. And like I said, it's probably going to be a good buying opportunity, not necessarily one to panic about. But these are the levels we want to watch and the levels that I think would concern me if they do break. That being said, our our bull market is still intact if we look at a weekly chart. And so everything I'm talking about today is still basically short to intermediate term. Long term, there's still a long way to go on all of the indices before we really have to worry about a market topping out or a market kind of losing its bullish nature. As you can see, if you look at just the weekly chart of the SPY, there's a lot of room to pull back, and we're still in a very strong, intact bull market. So the key here is don't panic and don't freak out based off what the market does in the very short term. Just understand where we are relative to the big picture and have a plan in place for whatever scenarios play out. That's kind of the reason, I try to predict what's happening in the market, but as you guys know, I usually try to play out at least one or two scenarios in our heads so that we are prepared for whatever happens one way or the other. Because you never really know what the market's going to do. All you can do is be prepared and have a plan in place to go ahead and attack whatever scenario does play out. And that's, in my mind, really the sign of a good trader is the kind of trader that rolls with the punches and reacts to what the market does instead of kind of sticking to his one theory and trying to force the market to behave along what he thinks it should be doing. So we'll keep an eye on these levels and we'll see what the overall markets do. Now, as a recap, I think we're still in very good shape, particularly in the intermediate to long term. But I do think in the short term the market is a little bit tired, and there's a chance that we pull back. And like I said, because we have earnings also in the next couple of weeks, a lot of big earnings, it makes it, in my mind, a little bit easier to kind of be cautious and not trade as much, because there really aren't that many names that are giving us appealing setups that don't report in the next week or two. And like I said, it's pretty hard to kind of force yourself into having a trade that's going to work in 3 or 4 days. You usually want to give yourself 10 to 15, maybe 20 days as far as normal short to intermediate term swing trades go. And we just don't really have that kind of window of opportunity right now until we start to see more of these names report. And then once that happens, we can trade them after the reports and see what kind of levels they establish as new support or resistance. Alright, so that covers the markets. Like I said, those of you that are in here, if you have a chart request, I would love to see it. I'd love to see your thoughts on not only what stocks you might have, but if you have any questions about what the market is doing. And if you have any questions about anything I just pointed out. Now, here's the U.S. dollar. As you can see, the U.S. dollar, it actually continued to drop. We thought last week maybe there was a chance that we find some support either as it started to stabilize at 24 or even when it came down to this area around 24.60. It has not done that. It has continued to fall back. That has given the market a little bit of wiggle room because it's not really putting pressure on it. Now, if we look at the individual currency crosses, we're not going to spend too much time with them, but if we look at the euro, again, this is going to be the opposite of that UUP chart because this is based off the euro, so up is good for the euro. You can see the euro made ground, got back above all its moving averages. We got the movement, the 20 starting to curl right back up. This was pretty bullish for the euro, at least as far as staving off what was becoming a bearish chart. It's not really out of the woods, but at least it's maybe back into trading sideways instead of breaking down further. There's room now for the dollar to kind of rally and put some pressure on the euro, and yet it'll still be a good chart for the euro. As you can see, all the moving averages are now going to offer as good support as well as this 119. So this was a pretty big flip as far as what was happening between the euro and the US dollar. And I think at this point it shows that the euro is still wanting to be above 119. And I think the next pullback to that area will probably be seen as a bouncing spot rather than as a chance for a further breakdown on the euro versus the dollar chart. And so keep an eye on this area if you are a Forex traders. That could be a good bouncing spot for a buy the dip play. Now if we look at the US dollar versus the Japanese yen, you'll see that the dollar has drifted down quite a bit versus the yen and has lost a good support level. Now, this is the one chart where the dollar did make a really good sort of change versus its other currency, the yen, and it had a very strong rally. It finally did pull back, and this has been seen as, I guess, broader weakness with the U.S. dollar. It is down to its 50. If someone wanted to play a bounce on the dollar, this is probably, of the three currency crosses we look at, this is probably the best candidate, although I don't think that at this point, this is enough of a pattern to suggest that it's done dropping. We need to see another couple green candles here confirming support at the 50 and see if it can kind of make its way back up about right around this level, around 108.30, 108.40. And then at that point, maybe it could be seen as a buying candidate. And then finally, the last one we want to look at is going to be the US dollar versus the Canadian dollar. And this one is probably the most bearish of the dollar charts. You can see even when it tried to rally, it had another big negative candle. Now, it didn't break down over the last week like the other charts did, but that's only because it's been breaking down for so long. And I think the key here, of course, is oil prices. If we take a look at oil, oil being, of course, a big commodity that's traded between the U.S. and Canadian governments. You can see, again, oil finally rallied, established this as maybe a new base, and tried to make its way back up. But as we can see, we're starting to see some trouble here again, right around 63. And I think at this point we might as well draw we'll just draw a new one. Starting to see a new little channel develop here. Right, and so we've got a range now for oil, and you can see it looks like 63.80 is going to be a ceiling in the short term. We'll see what happens. It could bounce off the two moving averages and make another attempt to break out, and if it does so, there's a decent chance it will break past it and try to make its way to 65. But if it stalls out again and heads back down, then it looks like it might range back and forth between about 64 and 58. So we've got a better picture now of what oil wants to do, at least in the short term. It was probably a good thing that it didn't break down, although I'm not a big fan of it breaking out as well. Like I said, oil right now is a pretty good proxy for energy demand and a gauge for what the marketplace considers our current recovery to be. Oil going up was in anticipation of more demand for energy, but if it got a little bit too high, it might reach a point where oil gets too expensive and energy becomes too expensive for us in the state that our economy is in right now. So it's kind of good that it's stalling out here, and we'll see where it goes from here. Then the last two commodities we want to look at is gold and silver. GLD did have a nice bounce, probably due to the dollar breakdown. I've been kind of bad-mouthing gold and silver for a while now. I still, even with this, I wasn't excited about this, and I'm still not excited about this bounce. It is nice that it formed a nice double bottom here, and it did break out. And I guess if it comes back down and retests 163 and holds, then that becomes a good trading opportunity. But at the moment, like I said, I'm still not that excited about this trade. There's still a lot of overhead resistance, and it's still a commodity that's going in the wrong direction. When we look at SLV, it's going to be a slightly different picture. Because it's mostly been trading sideways, and again we had a nice bottoming pattern and a breakout, but it is still contending with a lot of overhead resistance, and like I said, within the scope of what we do with these Wednesday market reviews, we tend to look at gold and silver as inverse dollar plays, right, as stores of value in case the dollar is dropping. For those that maybe look at it for a different style of trade, this might give you a different picture. But as far as what I look at this as kind of being an inverse play on the dollar. And I feel like lately it's just been superseded by Bitcoin and Ethereum. Now, Bitcoin did have a pullback, and a lot of cryptocurrencies had a pullback over the weekend, and actually had a pretty significant drawdown. It doesn't look like a lot on this chart, but percentage-wise, it did go from 63 all the way down to 50, or 51, 52, which is a pretty big drawdown. And we saw it across the board on most of the cryptocurrencies. There's a chance that Bitcoin needs to pull back even further. As you can see, we've got a drop on the trend line here. This often happens when you have a strong trend like this. It doesn't necessarily mean that it's a top. Just to kind of reiterate, if we go back and take a look at the Nasdaq, you can see back here it had a very strong trend, and once we dropped that, it didn't lead to a market top. It just led to a sideways consolidation range that took a bit longer, and then eventually made its way back up. And so this pattern we're seeing now is not necessarily the death of Bitcoin, but it is a bearish development in the short term. And we'll see what ends up happening. If it does roll over a bit, there's room for a further pullback down to about 46 to 45K. And I think that is probably going to be a good buying opportunity for those that look at it at that point. And then even further down, all the way at 35, I don't expect it to get down to that level. anytime soon. But if it did, I think that would be a massive buying opportunity for anyone that missed the last time it broke out in February and ran up to these levels. Now, in contrast to that, Ethereum didn't quite do the same thing, and in fact, actually, it did break down. As you can see, we had the same volatile pullback again from about 2,500 down to almost. It even reached almost 2,000. Or actually did reach 2,000, and that's a 25% drawdown in the span of 3 or 4 days. Is part of the reason why traders avoid this, or a lot of traders avoid these. But again, it had the same sort of move right back up in the next 2 days. So this kind of volatility is what I'm drawn to with these names, because you could get very big moves on these in very short time frames, as long as you know what your risk is and you can manage it through position sizing or through stop losses. So that covers what I wanted to cover today. Like I said, those of you that are in here, if you have anything you want me to look at, feel free to add it. I'm not sure if Sammy, I think you were the one that asked about Doge last week and was asking about when you should take profits or if you should sell, and I had mentioned that you might want to take partial, but to definitely not get rid of your whole position. And this is why I'm not a fan of early profit taking on, well, I'm a fan of profit taking, but I'm not a fan of closing out positions on some of these cryptocurrencies too quickly, is because they can run up pretty extreme numbers pretty quickly. As you can see, this thing went from 7 cents all the way up to basically 40 cents in the span of 3 or 4 days. So hopefully, if you are in here, or if you're not, if you're watching this, if you watch this on YouTube, hopefully you did what I was hoping you would, and just take some profits, but kind of held the rest, looking for a bigger move. I think at this point it's probably this is a much better profit-taking opportunity. But like I said, I don't like to abandon my entire positions on these types of names, because you just don't know how far they could run up and how much you can double or triple your money on them. So with a lot of these cryptocurrencies, even one like Doge, which is really just a kind of a joke coin, there's so much momentum coming into the space that you want to make sure you take advantage of it. And like I said, it's not just Doge. That's maybe the biggest example, but you look at VeChain. And by the way, for those that maybe are curious, I actually do not own Doge or have not traded Doge. But I do have some friends that have and made significant gains on it. But something like VeChain, which maybe is a little bit more of a respected coin, has done something pretty similar. Maybe not as drastic, but from 9 cents all the way up to 23, 24 within the span of a month is also pretty nice. And it's not alone. There's plenty of these coins that have done stuff like this. Matic has done fantastic moves from 4 cents all the way to 35 to 45. So there's a lot of volatility here for those that are willing to go ahead and accept the risk and try to take advantage of some of these big moves. Now, like I said, it's a sword that cuts both ways, because you'll have these drastic drawdowns as well, and they're not immune to what's happening in the markets right now. At least what happened over the last Friday, Saturday, Sunday. The markets and cryptocurrencies all kind of pulled back, and we're starting to see some green today and yesterday. But there's a lot of potential here. And like I said, we kind of went over it a little bit last week with Doge on my process for trading cryptos, which is a little bit different from trading stocks. With stocks, I'm a little bit more regimented about taking profits. With cryptos, while I do take profits, I'm more inclined to let them run, because they tend to really run a lot more than maybe stocks do. Alright, so like I said, that covers it for today. If no one has a chart request, we can go ahead and wrap it up here. If anyone feels during the week that they have a question they want to ask, or if they have a chart they want me to look at, you can always message me on Twitter. I'll be more than happy to send it to you through there. You can always visit me on Patreon as well, or visit us on our Discord, and I'm more than happy to go ahead and answer your questions. Even if you want to email me, stockdarts@gmail.com, I'd be more than happy to email you there as well, and to kind of help you out with whatever chart you're looking at. Other than that, I hope you guys have a good rest of the week, and we'll meet again next Wednesday. Like I said, keep an eye on earnings, as they can introduce some volatility, and we're going to have a lot of big earnings over the next week or two. Okay? All right, have a good rest of the day.